Hello and welcome to another lesson in our series of education on technical analysis. My name is Chris Capri. I'm the founder of Second Skies, and today we're going to be talking about trading with moving averages. The first thing I want to talk about is moving averages, just their basic design here. So moving averages are very simple in design. They're just one line on your screen. They're strictly designed for trends and trending pairs. In ranges, they don't really give us any information at all or very little and are not really useful. They're great as a whole for getting in the beginning of a trend and identifying the end of a trend, but not necessarily picking the tops and bottoms per se. And they can often act as support or resistance for a particular pair. Now, the one moving average that I like to focus on most is the exponential moving average, and that's because it's more sensitive to price action. It's a little bit quicker to react. If you're using a longer time frame, then the lesser the weight it has to recent price action. But if you're using shorter time frames, such as day trading or intraday trading, then it's going to have more weight to recent price action. Let's take a look at this on an actual chart just to give you an idea of how it is more sensitive here. So you see these two lines. The blue line is the simple moving average, and the red line is the exponential moving average. Notice how it's a little bit tighter towards price action when it's making those sort of breaks. So it's going to be a little bit more reactive or responsive to price action, and it's going to ideally get you in trades a little bit quicker and most likely get you out of them also a little bit faster because it's more sensitive to the most recent price action per se. Now, I want to talk about how they're effective in trending markets and then show you how really ineffective they are in ranging markets. So moving averages, if you do not know, moving averages are taking the, pretty much on a very simple level, taking the average price level for that particular pair over a specified time frame and then plotting a line to show you what that average price level is. So if the pair is stuck between a particular floor and a ceiling, then the line really won't gain any ground or lose any ground, and it's not going to really give us any information because the average price is not really changing that much. Where it comes in handy is when it starts to trend and the average price is accelerating or decelerating to the upside or the downside, then the moving average now becomes a very useful indicator. So again, here in ranging markets, you can see how it really didn't give us any information. But once the pair started to trend, the moving average started to move up at a relatively consistent angle, telling us that buyers are coming in at a steady, consistent, accelerative pace. When the pair starts to end the trend, then the moving average starts to flatten out, giving us clues ahead of time, and then once it breaks it, it starts to dip even a little bit lower. Same thing happens again when it starts to trend again. The pair starts to move it, or the moving average starts to move at about a 45-degree angle, telling us that there is an acceleration of buyers, or the speed at which buyers are coming into the market. Now, one of the techniques that I like to use, besides the moving average turning in the particular direction of the trend, is I usually like to find some sort of impulsive move followed by some sort of corrective move. And so usually when you see impulsive moves followed by corrective moves, the next typical move is a continuation in the same direction. The way I like to trade is I try and find the general floor for that particular pair during its consolidation period, and then wait till the price action starts to get down below the moving average and starts to treat it consistently as resistance. This is kind of telling you now that it's becoming an evolving resistance level, and once the moving average starts to move at a 45-degree angle sharper to the downside, in this case, then that tells you that there's a serious acceleration of sellers coming into the market, and so I wait for the break of the support, and then as long as the moving average is moving at a 45-degree angle or sharper to the downside, once support is broken, then I enter the trade. In terms of getting out of the trade, though, in general what I like to do is wait for the moving average to flatten out. If you start to wait for it to flatten out, you could have gotten in out of here, or you could wait for a break of the moving average or a close, an hourly or 2-hourly candle close above it, telling you that, okay, now the average price level is shifting to the upside, and this is due to buyers, so I should exit the trade. Here's another great example of how it worked with the euro-dollar. So it had a double top ceiling here, but then the moving average starts to move at about a 45-degree angle. Price broke the previous resistance level and then retested it 4 days later. Moving average is still moving at 45-degree angles, and there's distance from the moving average, suggesting that there's a lot of strength in this upside move. And so then this is the place where I generally like to go long, again taking profits when either the moving average flattens out or we have a good, in this case, since it's a daily chart, a daily close below the moving average. And you can see how the moving average keeps you in the trend for a long period of time, much longer than most traders generally are used to. And the advantage of that is it keeps you locked into profit a lot longer. One other moving average that I like to use is also the 200. I like the 200 because it's such a big number that doesn't happen that much that the market is usually going to respond to it. Most technical traders are watching it. The first time a pair ever gets to a 200 moving average, if it's been away from it for a while, you usually get some sort of response or bounce off of it. In this case, we pretty much did. So if you're looking for a quick intraday trade, you can place, in this case, a reversal off the moving average, trying to get a good 50, 60 pips and then exiting quickly. Once the pair broke through it, it had several moments where it treated it as resistance. And same thing here. The first time it touched the 200 EMA in a couple months, it had a response to it and could have gotten you a good 60, 70, 100 pips real quickly. Once it breaks above it, then you can pretty much feel confident that the pair should continue to move in that direction, at least for several candles. Here we had a nice confluence of the 20 and the 200, and once it broke below that, that became a very good sell signal now because the moving average has now acted as resistance, and you can see the curvature, the subtle curvature in the 20 moving average now moving downward, suggesting the selling pressure is on. To sum it all up, moving averages are a trending indicator. They give us very little information or almost no information on ranges. They're great for identifying support and resistance levels within trends, and they become an evolving support and resistance level. So as the pair continues to move in one particular direction, the moving average can often be some sort of resistance or support. The two that I like to use most consistently are the 20 and 200 because they're going to give you the least amount of false signals, whereas the 10 can be violated very often. The other thing to look for in terms of the moving average is the direction. The direction of the moving average is really going to give you a cue to where the trend is going. If it's moving up or down to a 45-degree angle, then the strength or health of that trend is very strong. The other thing about moving averages is that it keeps you in the trade as a whole, but it's not necessarily the best at picking the final tops or bottoms for it. So don't expect to get the entire move if you're using the moving average as both your entry and exit. And that pretty much sums up everything that we do. So for those of you that don't know, we offer private education, just talking about some of our services. We offer private one-on-one education and mentoring via online webinars. So if you're interested in further education, we do specialize in that. We also just recently in 2008 launched our 2S Sniper system, which has been performing very, very well. It's been quite excellent in terms of its results. And so if you're interested in just having a trading system for you, built for you, where you have no longer any guesswork, well then this takes all the work out for you, and it just gives you the signals to enter and exit trades. The other service that we offer is we offer trade signals and live market analysis twice a week. So if you're interested in getting live analysis and continual education and feedback on the market, we do this, and then we also give trade alerts, continually monitoring the trades throughout the week. And so that's pretty much it. If you have any questions or you'd like to find out more about us, please visit our website, www.2ndskies.com, or email us, info@2ndskies.com.